Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 4 companies to keep on your watch list for the upcoming trading week. And every single Sunday, we discuss the upcoming major events and earnings over the next few trading sessions and go over the companies who may be impacted. But over this next week in the market, it's going to be really boring. The second quarter has just ended. We're not expecting any major product launches, not many earnings reports, and no major conferences, that there's not too much to plan for and watch out for over the next trading session. So going forward in this video, I went through and found 4 companies, 1 high risk, high growth play, and 3 blue chip, dividend paying companies, at least worth keeping an eye on over the next few days. And for each company, we're going to go over their current operations, their financial status, and the long-term growth expectations for many years going forward. So although there's no major events taking place over the next few days, some blue chip dividend paying companies and a strong growth player that has a little bit more associated risk, we're taking a look at in your portfolio. But before we can jump into stock number 1, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and the first dividend paying company we're going to take a look at in this episode is ticker NEE, which is NextEra Energy. They currently trade for $74 per share and are up by over 20% on the 1-year chart. This is a main player in the energy/utility sector, and they have a market cap at $145 billion with a dividend yield slightly above 2%. And I've included NextEra due to the company's recent trading performance. From a high point of around $87 per share back in January of 2021, the company is now down over 14% to get back to the $74 level. So when most of the market is trading at all-time highs, this company is on a slight dip as of late, down 14%. So definitely a strong player in the energy and renewable sector to take a look at for your portfolio on the 15% decline. And I have personally bought more of this company over the past few months during the big dip. And I now own 55 shares of NextEra with a market value of just over $4,000. And I may continue to buy more, even bringing up my average cost per share, because I do believe in the company long term and the total potential to see some exponential growth in the share price and the dividend over the next decade and beyond. And if we take a look from their latest investor presentation, the company operates in 2 main business segments. They have FPL, which is their traditional utility company, and it's the largest electric utility within the United States. And they also have their renewable business, which is the world leader in electricity generated from the wind and the sun. So solar and wind energy is the future, and the fact that this company is a main player and the leader already is a great sign for the development of natural resources and renewables over the next few years. And if we take a look, they are the number 1 position compared to their peers within the United States, and they own one of the largest clean energy portfolios in the entire world. So right now, the company's done a great job of transitioning away from not only their traditional business, but building out a portfolio of strong assets in solar and wind power. And we can see over the past 15 years, this company's delivered some incredible growth. Their adjusted earnings per share for a utility company is growing at a CAGR of 8.7%, and their dividend per share over the past 15 years is growing at 9.6% overall, which is very impressive. And we can see over the past decade, they've returned a total of 700% to their shareholders compared to the S&P 500, whose total return sits at 267%. So this company has a very long track record of outperforming the overall market, a very strong blue chip dividend paying company that is expected to see some continuous growth without slowing down. And we can see over the next few years, they're forecasting 6 to 8% annual growth in their earnings per share, and they continue to grow their dividend at 10% per year through 2021 and at least 2022. And if we take a look at that dividend, a current yield just above 2%, they have an annual payout ratio of $1.54 per share, and their total net income payout ratio sits at only 61%, which is very low and sustainable, especially within the energy and utility sector. And their 5-year dividend CAGR is at over 12%, so you are getting some nice fast dividend growth, and their dividend growth streak sits at over 25 consecutive years, making this company a dividend aristocrat. And according to Simply Safe Dividends, they come in with the highest dividend safety score possible with a 99, so it's extremely unlikely that they cut their dividend anytime soon, and this company's been performing very well. So NextEra is a big player in the traditional and renewable energy sector. I own them in my personal portfolio, and the fact that they're down 15% from their high, they're definitely coming to keep your eye on during this boring week in the market up ahead. And now we're going to move on into stock number 2 for this Sunday's episode, and it is ticker MS for Morgan Stanley. They currently trade for $92 per share, and the big investment bank is up by over 92% on the 1-year chart. So of course right now, the entire financial industry is trading near all-time highs, so for many investors, now would be the time to go away from banks rather than buy into them. But going forward throughout the rest of 2021, some of Wall Street's top analysts believe that banks are going to have a ton of value and still continue to grow. They see the value plays like the financials leading the way in the second half of this calendar year. So although Morgan Stanley has already climbed to new highs, they're not expecting the growth to slow down anytime soon. And if rates do begin to rise, it's only more beneficial for the banks, and we should see increased revenue and earnings over the last 2 quarters of 2021. So if we take a look at Morgan Stanley right now, the big bank has a market cap at $171 billion with a forward PE ratio of only 13. And just last week, we got a major announcement from the company that they have actually doubled their annual dividend. Morgan Stanley doubled their annual dividend from 35 cents per share per quarter all the way up to 70 cents per share per quarter. So now the current dividend yield on the company going forward sits at around 3%. This number has not been updated for the double of the dividend, meaning the current yield on cost right now, if you were to buy into Morgan Stanley, currently sits at around 3% overall, making it one of the higher yielding banks within the entire financial sector. So right now, even though these companies are trading near all-time highs, you can lock in a nice average 3% dividend yield, which may be a great addition to a dividend growth portfolio. And if we take a look at the company's income statement, even through the 2020 pandemic, when the big banks like JP Morgan, Bank of America, and Wells Fargo all saw a decline in total revenue, this company did not. If we take a look at the 2020 number, revenue actually increased throughout the year to over $48 billion, and now in the trailing 12 months, it is up to over $54.6 billion. They've added $20 billion to their total top line over the past 5 years. So Morgan Stanley continues to be impressive, even through some of the most volatile times in our market and the fastest bear and bull market we've ever seen. And if we take a look at the company's bottom line, they're extremely profitable, and net income has hit new record highs as well. Close to $11 billion of profit in 2020, now up to over $13.4 billion during the past year. So of course, the entire financial sector we thought was going to get destroyed, but it really shows that these companies still performed extremely well during a massive bear market and pandemic in 2020, and now in 2021 with rates starting to rise, we're expecting some major growth coming going forward over the next 12 to 24 months. And if we take a look at the bottom line, around $6 billion of profit back in 2016, and that is more than doubled to over 13.4 in the trailing 12 months. So year after year, Morgan Stanley continues to impress. The big investment bank has seen some record trading revenue, the top line has exploded as of late, and going forward, we're not really expecting it to slow down anytime soon. So although the company is currently trading at a record high price point and valuation, I am going to keep my eye on the stock over the next trading week. If we see any red in the market and JP Morgan falls in share price, I may add this company to my personal portfolio. I agree with the major analysts. I do believe banks will continue to perform well in the second half of 2021, and although the company is trading at an all-time high right now, I personally believe, in my own opinion only, that Morgan Stanley will be a bigger bank over the next 5 to 10 years compared to where they are today. And of course, as a dividend growth investor, I love the fact that they have just doubled their annual dividend and now will have a current yield right around 3% if I do plan to start a position. So Morgan Stanley is the second stock we're going to take a look at in this episode. The big investment bank just announced a major dividend increase. They have seen some incredible performance as of late and definitely worth keeping your eye on over this next trading week. And now we're going to continue on into stock number 3, and we have another high dividend paying company with ticker VZ for Verizon. They currently trade for $56 per share and are up by only 3% on the 1-year chart. The company has a market cap at $233 billion with a very low forward PE ratio of only 11 and a massive dividend yield right around 4.5%. So the big communication company has very strong cash flows and operations and is expected to be a main player in the sector for long into the future. And I've included them in this week's episode because we have reports dated July 2nd, 2021, so very recent, that some of Wall Street analysts as well are looking for some nice income producing assets in this current market environment. Although rates are expected to rise going forward, they're still at a very minimal rate. So right now, some investors are looking for some nice income producing portfolio assets like Verizon, which could lead to some continuous momentum and growth in the value plays over the next few months. And if we take a look at the company's income statement, Year over year, total revenue continues to grow at a very slow rate, and we could see in 2020, they did have a slight decline in the top line, but very minimal impact from the 2020 pandemic. This company's business model is extremely strong. People will continue to pay their cell phone and wireless plans even throughout some of the toughest economic periods. So going forward, Verizon is still a beast to own in a portfolio. You're not going to get any massive growth, but for consistency and some slight annual dividend increases, definitely a company we're taking a look at. And we can see in Q1 2021, they had some very strong cash flow. So if you're unaware, a dividend gets paid out in cash. So what's really important for a dividend paying company is their free cash flow or the capital available to them to pay out in the form of a dividend every single quarter. So we can see right now in Q1 2021, the company's free cash flow was at $5.2 billion, which was up from $3.6 billion in the prior year. So some major increases to their total free cash flow year over year, which is a great sign. And we can see they paid out $2.6 billion in the form of their quarterly dividend, giving them a free cash flow payout ratio right around 50%. So they have half of their cash flows going out in the form of a dividend, and the second half used to pay down debt, grow their operations, and expand the business. So overall, Verizon's massive dividend yield at 4.5% looks to be sustainable at this current level. And their dividend payout ratio in terms of net income currently sits at around 49%, and their 5-year dividend CAGR sits at 2.15% overall. And according to Simply Safe Dividends, the company's payout is considered very safe, coming in at an 87, so we're not expecting a dividend cut to come from Verizon anytime soon. So I've included them as the third stock in this Sunday's episode. Like I already discussed at the beginning of the video, nothing really happening over the next week, kind of a boring week, a shorter week in the market, and nothing too exciting. So if you want to add some dividend income to your portfolio and you're looking for some high current cash flow, Verizon is definitely a company to keep your eye on. And now we're going to move on into the fourth and final stock we're going to go over in this episode. And I'm going to give you a fair warning before we jump into it that this company is nothing like the first 3 names we've already taken a look at. We've gone over 3 blue chip dividend paying companies that are all highly profitable and return billions and billions of dollars worth of capital to their shareholders every single quarter. And this company we're going to take a look at right now is in the very early on growth stage. This is a very high risk company. There is a ton of associated risk when buying into the stock, and it is extremely volatile. So keep that in mind when looking at this company, but they do have a major event coming up over the next week, which is definitely concerning and definitely will lead to some nice volatility in the share price if you're looking to start a position. But like I'm going to mention again, I'm not a financial advisor. The stock we're going to take a look at is very risky, so keep that in mind before making any investment decisions. And the fourth and final stock we're going to go over is officially SPCE, which is Virgin Galactic. They currently trade for $45 per share and are up by 176% on the 1-year chart. They're trading with a market cap at over $10 billion, and this company barely generates any revenue. They're losing billions upon billions of dollars every single year, and of course their focus on development of different hyperspeed air travel and space exploration. So Virgin Galactic, I have included them in this week's episode because they plan to launch their founder, Richard Branson, who's a billionaire, into space on July 11th to beat Jeff Bezos. So of course, Jeff Bezos announced in mid-July he will be going into outer space with his brother, but now Richard Branson, who originally wanted to be the first billionaire in outer space, is doing it and has a planned flight on July 11th through his Virgin Galactic spacecraft. So I'm expecting a very volatile week in the market for Virgin Galactic stock leading up to this major space mission. And if we take a look at the share price over the past 6 months, the company is up more than 93% on the 6-month chart, but let's look at how volatile this company really is. From $23, they grew over 140% to over $59 per share. Then from around $60, they then fell by over 73% to around $15 in middle May 2021. So then a month and a half later, from $15, they grew all the way up over 260% back up to around $56 per share. And then just over the past week, they have fallen back down another 20%. So overall, an extremely high risk and volatile company. So keep your eye on them over the next few weeks if you're interested in space exploration and if you believe in the long-term success of Virgin Galactic. This is in no way a short-term investment. If you want to buy into this company, you have to believe in the goal that they'll become a major player in exploration in outer space and supersonic travel across the world. And of course, one thing people don't know about with Virgin Galactic is they're not trying to become only a space tourism company. they have a much bigger vision for the overall business and the revenue generation activities. They've actually building out their Mach 3 aircraft, which is designed for high-speed travel from all around the world. And they're expecting this to be the fastest ever created aircraft that can take you all around the world in only a few hours. And in a recent interview, one of the company's executives gave some expectations and some numbers of the future potential results of this new supersonic jet. And taking a look at the numbers, they're absolutely spectacular. The new business jet could travel from New York to London in only 90 minutes. They plan to change international air travel. Over the next decade or two, if this science and this technology continues to develop and become real, you can travel all around the world in only a few hours. Flights that used to take 20 plus hours to get to their destination can be done in less than 5. And it's incredibly impressive how fast these designs can be built, and the company's projection of 2,300 miles per hour is the fastest that's ever been built. So we can see right now, these flights are very small, holding only 19 passengers, but as time goes on, they plan to expand the aircraft, allow for more capacity, and build a huge fleet of these vehicles to actually travel all around the world at a much faster rate. So I wanted to share the perspective that Virgin Galactic is doing much more than just space exploration. They're building out multiple different vehicles for many different uses. But keep in mind, if you are a shareholder in this company, please expect a very volatile road going forward. And even though they are having a major launch this upcoming week, if it's successful, the share price may skyrocket. If it's bad, it may crash. And no one knows exactly what's going to happen. But I think this is a company worth keeping an eye on in a very boring week in the market. Like I've discussed numerous times throughout the video, not much is going on, no major earnings, no major reports, so definitely worth keeping an eye on over the next few days. And now we're going to wrap up the video. I want to thank you for watching all the way to the end. Please hit that like button and subscribe if you already haven't done so. We took a look at 3 blue chip dividend paying companies and 1 high risk, high reward investment in Virgin Galactic like we see here. So of course, like I said numerous times, I'm just going to repeat myself once more. Very boring week ahead in the market. This episode, of course, is not as exciting as the usual Sunday episodes, but I do think it's a necessity to keep your eye on some companies every single week in the market. You never know when you'll find some good deals, and during the boring periods, you might find a diamond in the rough and something worth taking a look at. So thank you for watching all the way to the end. Please hit that like button and subscribe if you already haven't done so, and I appreciate you tuning in all the way to the end, and I will see you in tomorrow's video.